On the morning of October 19th, the selling starts.
Today is Black Monday, the day the Dow dropped more than 500 points, the day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
Across Wall Street, trading floors descend into chaos. Screens flash numbers that do not seem real. Secretaries are crying in the hallways. Senior partners at Goldman Sachs huddle behind closed doors in emergency meetings, trying to calculate whether the firm will survive the week. David Tepper, 30 years old, walks onto the floor and starts buying. While the rest of the desk is dumping positions at any price, Tepper moves in the opposite direction. He accumulates deeply discounted bonds in financial institutions crippled by the crash. Banks and brokerages whose debt is trading at a fraction of face value because the market assumes they are finished.
His logic was cold and structural. These weren't small community banks. They were large financial institutions with real assets, real deposit base, and real relationships with federal government. The market was pricing them for extinction. Tepper's thesis was that extinction was not going to happen. The government had too much at stake. So, he was essentially buying bonds at liquidation prices for companies that were not going to be liquidated. So the gap between the market sphere and the actual probability of failure was enormous, and that gap was his profit.